Hello and welcome back to Business Matters at the Hindu with me, K. Bharat Kumar. The global economic scenario is gloomy, and that's starting to tell on India's exports. Exports for October declined 16.7%, the first decline that we've seen since February 2021. And remember, that period of 2021 was when the globe was in the grip of a deadly pandemic wave. Imports rose lesser than usual, but probably because of softening commodity prices. Despite a slower imports growth, trade deficit widened by as much as 50%. As discussed in earlier episodes of Business Matters, trade deficit widening tells on the rupee value, and that in turn affects future exports and imports value. Engineering goods, which have lent a strong shoulder to India's goods export in recent years, slid 21%. The government had set a target for FY23 at 127 billion for the sector, which means we ought to have exported 74 billion worth in the April-October period, but we came up short at 62.5 billion. Engineering Exports Promotion Council India Chairman Arun Garodia attributed the slowdown to high inflation in developed nations, falling demand in China, a slowdown in the EU, fear of a slowdown in the US, and the Russia-Ukraine war. Electronics goods exports gave reason for cheer, growing 38% to $1.8 billion. Explaining the overall export slowdown, the Commerce Ministry said that typically in the month of Diwali, output tends to go down because workers tend to take leave and go home and so on. And it said we needed to wait and watch whether this decline in exports is a blip or is a trend that is here to stay for some time. In this context, it's interesting to view how other exporting nations have fared. Vietnam recorded a 4.5% growth in exports from a year earlier and cited sustained foreign demand, according to tradingeconomics.com. It is true, though, that its exports too have been slowing as the trade surplus it enjoys, that is, with imports being lesser than exports for that country. So the trade surplus declined for the fifth consecutive month. Philippines, another nation known for its exports, does not have October data out yet, but said that exports rose for the first time in 3 months in September amid what it calls signs of reviving foreign demand. China, of course, is a premier exporting nation, but we didn't look at data for China this time around because it's an outlier example. Stringent COVID-19 lockdowns have impacted output for that country, and experts say, if anything, at least in the area of electronics, India should stand to gain if companies slowly look to moving out of China to other destinations like Vietnam, India, and the Philippines. For any country, imports are a leading indicator of domestic demand, and in India's case, imports have been growing, but the rate of growth has been moderating consecutively for 4 months now. And especially petroleum imports in October declining is sending off alarm bells. It's still early days yet though. But what is clear even right now is that the government does need to urgently bring out a revised foreign policy. This is to address both our historical trade imbalance and the more recent slowing of exports. The Hindu's editorial in mid-November pointed out that this needed to be done at the earliest rather than wait out the tumult as the government intends to, having again deferred the new policy release till April next. The monthly economic review for October, released last week by the Finance Ministry, acknowledges that exports indeed have been slowing, but feels that domestic demand will carry the day for us. The report says the global slowdown is driven by what it calls the confluence of stubbornly high inflation, rising borrowing costs, and geopolitical tensions, but cites local demand as being resilient. It also expects a reinvigorated investment cycle which will spur growth and job creation in the coming days. Last year, exports, both goods and services, accounted for roughly about a third of our GDP. So to expect 2/3 of the economy to make up for a slowing 1/3 is no easy task, especially at a time when India, like other countries, is fighting runaway inflation and struggling with jobs growth. Significantly, the Finance Ministry says that high inflation has been recently more driven by domestic reasons than for imported causes. It says that given the easing international commodity prices and the arrival of the Kharif crop, those pressures should ease in the coming weeks. You may recall that inflation has been high at 7% and above for several months now, but dropped to just below 7% at 6.8% for October. In the report, the ministry also pinned hope on the fact that last month saw the lowest sign-ons for the year for the Employment Guarantee Scheme, indicative of a resurgence in private jobs growth. It is also hoping that a spike in tractor sales in September and October reflects improved sentiment. One seemingly positive signal for the Indian economy right now seems to be private capital expenditure. Typically, when companies sense local demand going up, they either invest in new manufacturing units or expand their existing assembly lines, create jobs, and start making products. The country's chief economic advisor, Dr. V. Anantha Nageshwaran, says that the country is on track to touch Rs 6 lakh crore for this fiscal in private capital expenditure. If that target is reached, media reports quote him as saying that that would be the highest in the last 6 to 7 years. Private capital expenditure depends on credit from banks or loans from the banking system, and that metric too has seen healthy growth in the recent past. It touched a high of 18% growth for the fortnight ended October 7th compared with a year earlier, though it tempered a bit in November. In fact, there have been video forwards on social media of bank branch managers and their teams going around residential areas with megaphones announcing attractive deposit rates in order to further their deposit collection, which could help fund credit growth. However, it still remains to be seen if this credit growth was purely due to inflation and a low base effect from last year. When we talk about trade, especially trade deficit when your imports are much higher than your exports, economists also tend to look at forex reserves as a sign of the health of the economy. How many months' worth of imports do our forex reserves cover? For the week ended November 18, foreign exchange reserves stood at about 548 billion. If we take October imports at about 56.7 billion, which is an 8-month low as a benchmark, then we have roughly between 9 and 10 months worth of import cover, which isn't as healthy as a 15-month cover that we had seen during the pandemic. But economists feel that this isn't as bad as we were in 2013 when foreign investors began pulling out of our financial markets. And that was when we had less than 7 months worth of import cover. And if anything, forex reserves have been rising for the 2 weeks consecutively, ended November 18th, shining some light of hope for the future. By the time you watch this video, the government would likely have announced GDP figures for the quarter ended September. But more on that in the future episodes of Business Matters. If you're a student of economics or international trade and trade relations, the coming months will likely give you a lot to educate yourself with. So do watch this space. Till the next episode, it's goodbye from us. Have a lovely week ahead.